Okay, thank you for joining us today. We're here with Rory Pinsky from Cetera Investors, and today's program topic is Savvy IRA Planning for Boomers, Strategies to Help You Save Taxes and Get More Out of Your IRA. Thanks for joining us today, Rory, and it's all you.
Thank you very much, Roseanne. Thank you for having me to West Hempstead. So we're going to get started in a moment, as I was just saying, but I'll have it on the recording as well. Please feel free to drop any questions in the Q&A field, in the chat field. We won't have time to answer them in this setting. It's not the most appropriate setting to answer individualized questions, but I do want to make sure that my partner and I find the time to answer that with you and go through this information as it pertains to your unique situation. So I'd encourage you, if you're in this chat or have access to it, to click the link to our team website, find a time to schedule a meeting with us, virtual, over the phone, in person, whatever it may be that best suits your schedule. But thank you everyone for attending this morning. Today, we're going to talk about Savvy IRA planning for baby boomers. You know, a lot of people have a strategy for accumulating money for retirement, but far too often, that's kind of where the planning stops. And that's not good enough. The reality is that a sound distribution strategy, in other words, a plan for taking money out of your retirement accounts, is just as, if not more, important, okay? So when it comes to your IRAs and other retirement accounts, you probably have a lot of questions, right? How much are my withdrawals taxed? When do I need to start taking? How much will I have to take? What happens to my IRA and retirement accounts when I pass? And perhaps most importantly, how can I minimize taxes so that I can spend most of my hard-earned money? All right. So my name is Rory Pinsky. As I mentioned, my partner in Kofi, John, work together at our branch office in Westbury, New York. But we are flexible. We do meetings over the phone, over Zoom. We do house calls. Okay, so whether it's you on the call today, watching this from home, or know someone right in another state who needs this information, we're happy to help. But now that you know a little bit more about us, let's talk about some Savvy IRA planning strategies. So, you know, years ago, life was simpler in a lot of ways, and retirement was the same thing. Many people went to work, and when they retired, they collected a pension, Social Security. There wasn't much needed in the way of strategies, and people weren't all too concerned about running out of money, since both their pensions and Social Security benefits were generally guaranteed and enough to live on. For most people, that, along with whatever else they managed to save, was probably enough. Today, though, things are different. A lot of companies, organizations have abandoned pensions and instead just turn to accounts like 401ks, 403bs. And what that does is shift many of the risks once shouldered on the organization now onto the backs of employees and their families. Risk of investing the right amounts of money, investing it properly in a risk manner that makes sense for you and your age and your situation. So retirees are now responsible for making a lot of the critical decisions that'll determine how successful we are in retirement, okay? And that includes keeping up with changes to the law that happened all the time. The Secure Act 2.0, made nearly 100 changes to the rules for retirement accounts, some of which we'll touch on today. The bottom line, though, is that now more than ever when it comes to retirement, we are kind of on our own. So on top of that, our retirement savings might have to last us a lot longer than we think. According to a Society of Actuaries report, over 40% of retirees underestimate their life expectancy by 5 years or more. Okay, so if we take a look at this chart, you'll see what I mean. If you're a man and you're 65, you have a pretty good chance of living to at least 85. If you're a woman of the same age, you have a better chance of living past 85 than you do dying before it. And if you're married and both you and your spouse are 65, there's a strong chance that at least one of you will live to be 90. And in fact, there's a 33% chance that at least one of you will live to age 95. So what this means is that our retirement savings might have to last us longer than we'd expect. Okay, that's, put all of this together and it makes having a strategy all that more important for retirement distribution. Sorry, I jumped around a few slides there. So with that in mind, one of the best things we can do as we approach retirement, if you're not already there, is to increase our retirement savings by contributing as much as possible to different retirement accounts. Although contributing at younger ages is more powerful in the sense of time value of money, compound interest, you may have been unable to save as much in your younger years because you were bogged down by things like mortgage payment, saving for a kid's education, right, and soccer equipment, and whatever else other expenses might be associated with raising a family. Chances are, though, that we don't have those expenses, or they'll be ending soon or going down in time. And as a result, we finally have some extra income that can be used to fund our retirement accounts, all the while we're in our peak earning years, right? And most of the time we're earning more than we were in our younger years. So just how much can we contribute to these different accounts? Depends on the type of account and a number of other factors. So we'll start with traditional IRAs. A traditional IRA, or individual retirement account, is a personal retirement account that offers certain tax benefits. So contributions may be tax deductible, and while your money is still inside the IRA, it grows tax deferred. Ultimately, when you take money out of a traditional IRA, the amount you take out is added to your income, and we'll talk a little bit more about that later. In 2023, and these numbers are updated, the maximum you can contribute to a traditional IRA is $6,500. If you're 50 or older by the end of the year, though, then you're allowed to make an additional $1,000 catch-up contribution, making your maximum contribution $7,500. However, you can't always make a traditional IRA contribution. For instance, to make a traditional IRA contribution, you must have what the tax code refers to as compensation. So for most people, compensation is income, but it also includes a number of other types of income, such as taxable alimony. It doesn't, however, include things like interest, dividends, capital gains, Social Security benefits, or unemployment compensation. But most of the time, if neither you or your spouse work, you won't be able to make a traditional IRA contribution. In the past, age was a barrier that prevented some people from making contributions, but that hasn't been the case since 2019. If you're 85 years old and you're still working on the books, you can still make IRA contributions. And traditional IRA contributions are tax deductible unless you or your spouse are active participants in an employee-sponsored retirement plan and your income exceeds an applicable threshold amount. Okay, we're happy to provide a key financial data kind of postcard that you could print out, have on the fridge, that has all these different limits, tax brackets that we'll go through today. So feel free to drop your email in the chat box, or click our website, get our contact information, email us as well so we could send that information over to you. Okay. Many of you probably know that there's other types of IRAs, not just a traditional called a Roth. So a Roth IRA are similar to traditional in many ways, but there are also some key differences. One of those differences is that you don't get a deduction when you make a Roth IRA contribution. Once your money is in a Roth, it grows tax deferred like it does in a traditional. But the big benefit of a Roth, and other key differences between it and a traditional, is that Roth distributions can be tax-free in retirement, not taxable. If you've had any Roth IRA for more than 5 years, and you're over 59 and a half, then all withdrawals from any of your Roth IRAs will be tax and penalty free. Okay, it's called a qualified distribution. Even if you need to take a withdrawal sooner, you could always take out your contributions or your principal tax and penalty free, just not any investment earnings. So some of the same contribution rules that apply to traditional also apply to Roth. For instance, the same $6,500 contribution limit applies. Similarly, if you're age 50 or older, you have that same $1,000 catch-up allowance. Okay, they're also subject to the same compensation rules as traditional IRAs. And if you have sufficient compensation, the only thing that can prevent you from making a Roth IRA contribution is having too much income. Okay. You can see the income limits up here on the screen. Note that if you're a single file, as long as your income is under 153, you can make a full Roth IRA contribution. Similarly, if you're married, file a joint return, then as long as your joint income is under 228, you can make a full Roth IRA contribution. If you think you're around that area, please be sure to speak to your CPA or accountant and see what you can do so that you fall under the limits and can make Roth IRA contributions if it makes sense. While some baby boomer couples retire at the same time, oftentimes one spouse retires before the other. And in such cases, you may be able to take advantage of spousal IRA, Roth IRA contributions. This is a special contribution that allows a spouse with compensation to make a contribution to the IRA of a non-working spouse. In other words, the non-working spouse can use their working spouse's compensation as their own. The spouse for whom the contribution is being made, however, must meet all the other contribution rules applicable to that specific type of IRA. So this is one of the most common questions I get when talking to baby boomers. You know, I'm in my 50s. Can $7,000, $7,500 a year in a contribution really make a difference when it comes to my retirement? I mean, I'm basically there. The answer is absolutely yes. So follow me on this example. Suppose you're 55 years old now, and you plan to retire in 10 years at 65, right? At that point, you're going to go on Medicare, all that good stuff. The kids have flown the coop. You finally have a chance to focus on saving for your retirement. So you make a full $7,500 Roth IRA contribution every year until you retire, just 10 years, 55 to 65. If, say, you averaged an investment return of 6% per year, which is hypothetical, keep in mind, then by the time you retire in 10 years, you'd have more than $100,000. But remember, you may need to plan on living until 90, 95 or longer. So let's say you leave this account alone and continues to earn 6% per year on average, okay? In the meantime, let's say you have Social Security, maybe a pension, we're drawing down 401k and IRA assets. We let this Roth account sit. By the time we reach 85, even if you never put another dollar in after the first 10 years, you'd have more than $325,000. Plus, since you made your contributions to a Roth IRA, that entire amount would be tax-free. So, do you still think that just or only $7,500 a year can't make a difference? And just think that if you're married and you're able to make that $7,500 contribution to both your Roth IRA and your spouse's IRA, you'd have twice as much tax-free money, okay? If you're still working and you do have access to one or more plans through your current employer, you might be able to do even better. While the limits on contributions can vary depending on the type of plan your employer offers, you can generally contribute a lot more to your company plan than you can to an IRA. So this year, the limit for a 401k, 403b, similar type of plan is $22,500. And if you're age 50 or older by the end of this year, then you can contribute an additional $7,500 as a catch-up contribution, bringing your total potential plan contribution to $30,000 per year. So depending on your plan's provisions, you may also be eligible to receive employer contributions, such as a company match, profit sharing contribution. As you can imagine, putting this type of money away, even for just a few years, can have a marked impact on your retirement savings. Plus, provided you meet the requirements we just discussed, you can make a contribution to your IRA or Roth IRA on top of your company plan contribution. And think about the impact that that might have on your overall retirement plan. Of course, at some point, you'll likely retire. And when you do, you'll be faced with one of your first major retirement decisions: what to do with the money you've accumulated in your employer-sponsored retirement plan. 401k, 403b, 457. In many cases, people choose to roll over their funds to an IRA, traditional or Roth, because they tend to offer greater control over one's retirement funds. A lot of times, employer plans, 401ks, 403bs, and the like, are not going to offer certain investment or insurance options that an IRA might have available if you do it by yourself through a broker, that sort of thing. They're not only the options, though, and such rollovers are not always the best move. Believe it or not, you may have as many as 6 different options for your employer-sponsored retirement plan funds when you leave work. You can see them up here on the screen. Each of these potential alternatives offer unique benefits and drawbacks, so it's usually a good idea to discuss your options with a knowledgeable professional, wink, wink, so that you can make the savvy decision that's right for you, your retirement, and your family, okay? All right. Getting money into your retirement accounts is always the first half of the story. And Kofi and I like to use the example of saving for retirement, but then actually retiring as climbing a mountain. Climbing a mountain seems like the hard part of that headline, right? But if you think about it, climbing the mountain is similar to saving up money for retirement. It's not easy, but it's simple. Just save money, increase the percentage, right? The hard part is making it down safely, okay? So when it comes to an efficient way of taking money out of our retirement accounts and avoiding costly mistakes, this is the other half of the story. Climbing up the mountain sounds glamorous, but making it down safely is the most important part. This is far easier said than done, particularly when it comes to your traditional IRAs, 401ks, 403bs, and other pre-tax or tax-deferred retirement accounts. These are accounts where you still have to pay the income taxes on it. In general, withdrawals for these accounts are taxed as ordinary income rates. Our withdrawals are added to our income and taxed at whatever bracket we find ourselves in. If our income is relatively low, we'll have a low rate for our withdrawal, okay? And on the flip side, the opposite, okay? So here's a quick look at the tax brackets for single and joint filers for 2023. We're happy to provide this information via email or in person, and remember that these are marginal tax rates. One of the troubling aspects of retirement planning is that the tax rate on your future distributions is unknown. Even if you can project your income with confidence, there's no guarantee that the tax rates are going to remain the same in the future as they are today. And while it's hard to find someone who doesn't think they pay too much in taxes now, the reality is that the top tax rates today are pretty low in a historical context. So take a look at this chart to see what I mean. When the income tax was first introduced in the year 1913, the top rate was 7%. But within just a few years, the top tax rate had already skyrocketed to over 70% to the top earners in the country. After dropping back down to as low as 25% after World War I, the top rate jumped back to 63% in 1932. From there, it wasn't until more than 50 years had passed when in 1987, the top tax rate finally dropped back down below 50%. Okay, letting those in the top tax bracket keep more of their income than they were forced to give over to Uncle Sam. Now, of course, not everyone pays the top rate. Very few people do. In fact, right, it's a very, very small percentage. That being said, with our national debt at all-time highs, a budget that hasn't been balanced in a while, and fiscal troubles for many of our entitlement programs like Social Security, Medicare, and the like, it is possible that rates can go up across the board in the future. So this makes coming up with the right strategy even more important, right? If all of our money is in a 401k, then we have to pay taxes on all of it. And if we are going to live potentially 20, 30, 40 years, that's a lot of uncertainty because a lot can change in tax rates over that time frame. Okay, to make matters worse, IRA withdrawals can cost us in a lot more ways than just adding to our income. They could also cause us to be phased out of certain itemized deductions, personal exemptions, various tax credits. They could increase our exposure to a 3.8% surtax on investment income. If I take an IRA withdrawal, I might have to include more of my Social Security benefits and income. And my Medicare Part B premiums might also go up as well. And that's just the beginning. If I want to avoid these issues, then I need a strategy. One way to minimize the tax impact of retirement account withdrawals is to avoid taking them. That allows our retirement money to keep growing tax deferred, keep deferring, right? And keeps that nasty taxable income off of my return for as long as possible. However, I can't put off taking these withdrawals forever. So once you reach a certain age, the law requires that you begin to take what are known as RMDs, or required minimum distributions, from our traditional IRAs. They also apply to any employer-sponsored tax-deferred plans like 401ks, 403bs, 457s. They're simply the bare minimum you're required to take from your retirement accounts each year to satisfy the tax code rules. The IRS is saying, well, that $1 million in your 401k, Mr. Smith, you haven't paid income taxes on it yet. And while I know you'd love to leave it to the next generation, we need to start collecting some of that income tax money while you're still alive, okay? So the specific age when you must begin taking RMDs depend on when you were born, okay? It used to be 70 and a half, then it was phased up to 72, okay? So if you were 72 or older at the end of last year, you should already be taking RMDs. For those of you who are still younger than 72, you'll have to start taking RMDs when you turn 73 or 75, depending on when you were born, okay? If you were born in 1960 or later, you'll have to start taking yours at 75, unless Congress, of course, changes the rules again between now and then, which is entirely on the table. A final thought before we move on, remember that you could always take out more, but if you fail to at least take the minimum RMD, the IRS can actually hit you with a 25% penalty for any amount that you should have taken out but didn't. To calculate our RMD, you need to know two things. What was your account worth at the December 31st of the year's end of the previous year, and your life expectancy factor. Getting your prior year-end balance is usually pretty simple. In most cases, you can look at your December fourth quarter statement, use the ending balance. Then you use your age to look up your life expectancy factor on a special table provided by the IRS and divide your prior year-end balance by that factor, okay? Also, if your account is held at a 401k, 403b, IRA with an investment firm or a bank, you know, most of these institutions can tell you what your RMD from the account you hold there is going to be. So we're not going to take the time to go through the specific math on an example here, okay? Of course, most people don't think about things in terms of factors or life expectancy. So I wanted to focus on this slide to let the numbers really have an impact and make sense. Okay, so this shows the approximate percentage that you'll need to take out from a traditional IRA or similar tax status account from age 73 to 90 in order to steer clear of that 25% penalty. So if you look, you'll see that each year the percentage you need to take out increases. That doesn't necessarily mean you need to take out more money each year than last, as that also depends on how much your IRA gains or loses from year to year. If you're someone who's already been taking RMDs for the last few years, you've probably seen a variance in income over the last few years, depending on how the investments perform inside of that account if they are invested. RMDs can actually get a lot more complicated. And as we've already discussed, the penalties for making a mistake can be pretty severe. So with that in mind, we're going to talk about 3 of the most common RMD mistakes that people make so that you can hopefully avoid them in your situation. Okay. Remember, part of any savvy IRA plan is minimizing costly mistakes. One common mistake with RMDs that people make is incorrectly aggregating their RMDs between different types of retirement accounts, right? So for example, you have a 401k and an IRA. After calculating your RMDs from each, they come out to $4,000 and $3,000 respectively for a total of $7,000. Now, let's say your IRA is earning a higher rate of return that year than your 401k. You might be tempted to just pull all $7,000 from your 401k, leave your IRA alone, and call it a day. After all, what's the difference, right? They're both retirement accounts, and whether you take $7,000 from your 401k or $4,000 from your 401k and $3,000 from your IRA, it's the same impact on your tax return. So you're logical in your thought process, but the tax rules aren't so logical, okay? They specifically prohibit you from doing that. An RMD from one type of retirement account, like an IRA, can never be taken from another type of retirement account, like a 401k, because even though they're the same tax status, they have different account titles. You can't mix them up, okay? However, on that note, before we move on to number 2, if you do have 3 different IRAs, those you can aggregate because they are all a traditional IRA. But if you have a 401k, a 403b, and an IRA, you have to take the RMD from each one. Another common mistake is people are aggregating RMDs between spouses. For instance, let's say you and your spouse file a joint tax return. Your RMD is $4,000, your spouse's is $2,000. To make things easy, you simply take $6,000 out of your IRA. Right? After all, they're both IRAs. You file jointly. It's going to go on the same return, this income. Doesn't really matter, right? It does. Okay. Retirement accounts are individual retirement accounts. IRA is individual. Okay. They can't be joint. There's no such thing as joint IRA or joint 401k. So you must take your RMDs from your own accounts. Third most common mistake with RMDs is forgetting to take one altogether. Although this should never happen, sometimes mistakes are made. Just the fact of life. Maybe a family member was sick. Maybe I got preoccupied. I was on vacation. Simply slipped my mind. Whatever the reason, if you forgot to take an RMD or you've otherwise made a mistake, the one thing you should do is, is forget about it and pretend that it never happened. In most cases, if you do that, the IRS can come back with that 25% penalty, along with a host of other penalties and interest indefinitely. One strategy to minimize the impact of taxes on your retirement savings is to avoid taking distributions from your IRA for as long as possible. This allows our dollars to enjoy their tax favorable status, deferred status for as long as possible. It also helps keep income off of our return, which, as you've already learned, not only helps keep your income tax bill lower, but could also prevent increases in other costs tied to your income, AKA Medicare Part B premiums, investment surtax, things like that. There are some major downsides to this approach, though. Most notably, as your IRA gets bigger, so does, I won't say your problem, but your tax bill. Think about it. If your tax bracket remains the same over time, then as your IRA grows, so does the amount you're eventually going to have to pay the government or Uncle Sam, right? This is much different than other things you might be used to in life. So for instance, let's say you buy a house for 200 grand and you have a $50,000 mortgage. If the house doubles in value to 400 grand, does your mortgage increase to 100,000? Of course not. You get to reap all the benefits of that appreciation, right? But that's not the way it works with IRAs and 401ks. If those accounts double in value, you don't get to keep all the gains. Uncle Sam is entitled to his share, right? Plus, by waiting to take distributions for as long as possible, your RMDs later will be larger. So this could increase the impact of some of those side effects that we've talked about and are trying to avoid by deferring our distributions. You might just be making the problem bigger, kicking the can down the road. Okay. Thankfully, there's a way to fix this so that, to go back to your mortgage analogy for a moment, right? You can own your IRA free and clear of taxes so that only you reap the benefit from future appreciation. Remember how we said Roth IRA distributions are generally tax-free? So there's a strategy called a Roth IRA conversion, right? And that's our next IRA planning strategy that we'll go through. This is a name given to a special type of transaction where I move money from my pre-tax retirement account to a Roth IRA. When I make a conversion, the amount of money I convert is added to my tax return for the year and is taxable at whatever income tax bracket I happen to be in that year. So for example, let's take Jill. And Jill has $100,000 in a traditional IRA and would like to convert it to Roth. We'll talk more about why she might want to do that in a moment, but just for the numbers' sake, if Jill moves forward with her $100,000 Roth conversion, she'll have to add $100,000 of income to her tax return for this year, which will be taxable at whatever rate Jill happens to be at that year. Because this is a big decision and can have significant impact on your taxes, it's always best to discuss this option with your tax advisor and financial advisor beforehand. Make sure that it's in your best interest and that you're doing the right amount. So why would Jill want to voluntarily claim $100,000 of income before she's legally required to and pay the taxes? There's a lot of reasons, but perhaps the most common reason is one we've already discussed: to pay off Uncle Sam now so that she owns the retirement account free and clear for life, and that any future appreciation in it is not subject to any taxes. Remember, with a Roth, you have the potential for future tax-free withdrawals of everything in your account. Something else to keep in mind is that unlike Roth IRA contributions, there are no restrictions on who can make Roth IRA conversions, when, or of how much. You can't be too old, too young. You can be working, retired. There's no minimum amount of income you need, no maximum amount of income you can have. Okay, I think you get my point. If you want to convert your IRA to a Roth, there is nothing in the tax rules that stop you from doing so, right? If you have $1 million in a traditional IRA or a 401k, Uncle Sam would love it if you can convert the entire thing to a Roth this year. Claim $1 million of taxable income, bump up 6 tax brackets. They would love that. That might not be the best way for you to do it, and that's why it's important to, we'll talk about specific ways, but to speak to your advisors, but there are no restrictions. The potential tax-free nature of the Roth IRA may also provide with additional benefits, such as a hedge against tax rates rising in the future. When it comes to our retirement, there are a lot of unknowns, right? What will the market do? What will inflation be? What will our tax rates be? So on and so forth. That last one, though, taxes, is a major concern for many retirees, and we've already talked about it a bit. A Roth IRA conversions can help manage that risk by paying taxes at today's known rates. If tax rates rise in the future, tax-free distributions from Roth IRAs will be even more valuable, right? You guessed right. Of course, if you think that your tax rate will be lower in retirement, then that would be an indication that maybe this strategy isn't right for you. Also, since Roth IRA distributions are in retirement are generally tax-free, they typically don't impact the other things tied to your income that we discussed earlier. Another big benefit of the Roth, and one that many retirees find attractive, is that Roth IRAs have no RMDs, required minimum distributions. Because all those RMD calculations and potential mistakes we talked about earlier, they're not an issue if I have a Roth IRA. During our lifetime, you can take as much as you want, as little as you want. You're not forced to take anything out at 73 if you don't want to. So your Roth IRA can continue to grow and compound tax-free for your heirs, which also makes it a very intriguing vehicle from an estate planning perspective. The Tax Cuts and Jobs Act, however, eliminated something known as the recharacterization option for conversions made in 2018 and afterwards. So if you can convert your Roth IRA now or in the future, you can no longer undo that decision, something we used to be able to do but can no longer. So even if our tax bill is higher than we thought, or if the conversion accidentally phased you out of a credit, or if your investments dropped in value, no matter the reason, you cannot recharacterize or undo that conversion decision. So with this in mind, it's important that you're sure that you want to convert your Roth before doing so. Here are some 3 questions to ask yourself before converting. Do you have a rough idea of the conversion's impact on your tax bill? Do you have a plan to pay the resulting taxes? Do you have a reasonable expectation that the benefits of prepaying your taxes like this make sense in your overall strategy? The answer to all of these questions should be yes. So now that we know we're going to, here's a helpful conversion strategy called filling up the buckets or the brackets. Here we have actual buckets to illustrate the point. Remember those tax brackets we looked at earlier? Well, sometimes you can find yourself in the middle of one of them with room to add more income without pushing yourself into one of the higher tax brackets. For example, in this year, the 22% tax bracket for married couples filing a joint return goes from about $90,000 to $190,000. So suppose then that I file a joint return, my taxable income is $100,000. That means that I could add another 90 of income without going into the next bracket. So making a Roth IRA conversions of that remaining amount could make sense. If I plan to convert a sizable portion of my IRA, this approach is often more tax efficient than converting the full amount at one time. Instead, I can make smaller Roth IRA conversions over a number of years, filling up my bracket each time. This helps reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period of time. Roth IRA conversions can be especially useful if you've had a low income year. For example, are you a business owner with unusually low sales? Are you paying high non-recurring medical bills that might be deductible? Or maybe I'm retired but not yet receiving Social Security benefits, pensions, IRA distributions. These are questions to see if a Roth IRA conversion might be a good move for you. Of course, these strategies aren't for everyone. As we can see here, there's no guarantee that a Roth conversion will achieve the intended result. There's a good chance that at some point during your life, you're going to want to move around some of your retirement money. Maybe it will be done as part of a Roth conversion. Maybe it will be to make a new investment, maybe to work with a new financial advisor. Whatever the reason, you should be aware of how to move money so that you don't make costly mistakes that could derail your retirement. In general, there are two ways you can move retirement money. You can either move it indirectly in what's known as a 60-day rollover, or you can move it directly via a direct rollover, trustee to trustee transfer, sending money from one institution directly to another. Moving money directly when it's an option is usually the best choice when it's available. So first, let's take a look at indirect rollovers. In this type of rollover, you receive a distribution of your retirement funds payable to you, or they are sent to a non-retirement account. Then you have 60 days from the time you receive your distribution to get it back into another type of retirement account. If I miss this 60-day deadline, though, the distribution is taxable, and depending on your age, it may be subject to an additional 10% penalty. Even if you're on top of things, you complete your rollover within 60 days, there are other potential problems with indirect rollovers. For instance, if your withdrawal is coming from an employer-sponsored retirement plan like a 401k, the plan generally has to withhold 20% of your distribution for income taxes. Congress wants to make sure that you don't take your retirement money, run away, and never pay the taxes that you owe, right? A separate troublesome rule applies to the 60-day rollovers from IRAs. If you're moving your money to another IRA, only one of these rollovers can be done per year, okay, in any 12-month period. If you try and make a second 60-day rollover, chances are the entire amount will be taxable to you. The same rule applies to Roth IRA rollovers, only one 60-day or indirect rollover in any given 12-month period. As you can see, there are some real problems with indirect rollovers. Thankfully, there's generally a better way to move your retirement money. In a direct rollover or trustee to trustee transfer, your money is sent right from your old retirement account to your new retirement account. There's no 60-day time limit to worry about. There's no mandatory 20% withholding, and there are no one rollover per year rules to be concerned with. Typically, this is done by providing you with a check made payable to your new custodian or institution. For example, the check might read something like Company X Custodian for the benefit of John Smith IRA. If the check is made payable to your new custodian like this, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There's no 60-day deadline, no mandatory withholding. That's true even if your plan sends you the check to your address and has you forward it to your new custodian, as long as it's filled out like what you see on the screen. Another essential component of any savvy IRA strategy is making sure that you coordinate your IRA planning with your overall retirement picture, okay? Your estate plan, your tax plan, your education plans, and other financial strategies. Your IRA and other retirement accounts can impact each of these areas, and it's important to factor those things into your strategies, right? Some of you may have all of your savings in retirement accounts. But many of you probably have some of your savings in IRAs, 401ks, and other types of accounts, okay? Some in non-retirement accounts. And if that's the case for you, one savvy strategy you may want to consider is coordinating your IRA with your overall strategy. Carefully selecting which of your investments are purchased with IRA money, which investments are purchased with non-retirement money. Doing so could help you meaningfully lower your tax bill. And that's why it's important to have an overall retirement income strategy, right? Everyone's different. Some people like having different people handle different accounts, but it is hard for any one person to give you cohesive advice if they're only managing 1 out of 10 accounts and each one is managed by a different individual institution and has a different investment style in it. Okay, we're going to breeze past this because it's going to get a little too into the weeds. And this is a conversation really meant with your financial professional tax advisor. And I don't want to lose us before the end, but we're happy to get more into these strategies in a one-on-one. Okay, of course, we should always be aware that anytime we're dealing with investments, there's no guarantee they're going to perform as expected. And while we don't anticipate the special tax rate for long-term capital gains to be eliminated anytime soon, there's no crystal ball to protect what Congress will do in the future. And this is put a bow on some of the investment tax rules as they compare to income tax rules that we just glossed over in the previous slides, but we're happy to talk about more in depth one-on-one. Okay. Another way that our IRA planning needs to be coordinated with our overall strategy is with our Social Security claim strategy, okay? If you guys have not already seen our similar presentation on Social Security strategies, I would recommend or strongly encourage that you schedule a time to talk to us about the Social Security claiming strategy or attend one of our many webinars or seminars on the issue. The decision on when to file for Social Security is one that far too many retirees make without thoroughly evaluating their options first. This is a major mistake and one that in some cases can cost you more than hundreds of thousands of dollars of income over the cost of your and your spouse's retirement. Obviously, the decision on when to claim Social Security is a very personal decision and one that varies significantly from person to person and couple to couple. That being said, many retirement experts today believe that too many people claim Social Security too soon. Remember, these benefits are guaranteed to last for your entire lifetime, no matter how long that is, and benefits are generally increased from 1 year to the next through cost of living adjustments. Additionally, if we delay benefits, past what's called our full retirement age, you can earn an additional 8% increase in payments each year until you turn 70 through what are known as deferred credits. Okay, a lot of you probably going through that break-even math of when do I need to live until for it to make sense for me to delay claiming Social Security. We are happy to run that calculator for you, but just remember it's not only that break-even point that should dictate that decision, it's your overall retirement income picture as well, right? What other income options do we have available to us? What investment accounts, how are they taxed are available? How are they performing? What has life expectancy in our family been? So we're happy to have that conversation with you as well. But we have to eat in the meantime if we're withdrawing for delaying Social Security, right? So that may require us to pull money from our IRA in the interim to help cover your current living expenses. A lot of people opt not to do this because they say, you know, what if I die early? I'll have spent my IRA money, which takes away money from my beneficiaries, and I'll have gotten little to nothing for it. That is certainly something to consider. Here are 2 reasons, just to play devil's advocate, to give that approach a second thought. Okay. A 2012 study, a report rather, from the Center for Retirement Research at Boston College concluded that Social Security is one of the cheapest, if not the cheapest, annuities available. And that is a pension, right? That may sound a little funny. After all, you don't buy Social Security. In a way, though, you kind of do. If you use your IRA money to hold off on claiming Social Security for, say, a year, that's kind of the price you paid to get the higher Social Security benefit. So if you compare that price, how much you had to take out from your IRA to replace Social Security while letting that delay, you can get from, if you compare that to the increased benefits of what you can get from commercial annuity providers, it's almost always cheaper. Okay. Another reason why it might make sense to draw from our IRA in order to help delay claiming is that Social Security benefits are generally more tax efficient than IRA withdrawals. Remember, when you make a traditional IRA withdrawal, the entire amount is generally added to your income and taxed at whatever rate you happen to be at. In contrast, Social Security benefits may be anywhere from 15% tax-free all the way up to 100% tax-free. So the key point for you is that trading $1 of IRA income on your tax return for $1 of Social Security benefits will almost always leave you with a lower tax bill and more money to spend. All right. Time to move on to our next Savvy IRA planning strategy. And I appreciate your patience here. I know we're moving very quickly through a lot of dense information, so we would encourage you to find a time to speak with us individually, and we can weed through which of this information applies most closely to your unique situation, okay? Our next Savvy IRA planning strategy is going to be coordinating our IRA planning with your estate plan. In most estate plans, there are generally two primary goals, right? First is to make sure that our assets pass to our intended beneficiaries. And secondly, that they're passed to them as efficiently as possible. When it comes to IRAs, 401ks, other retirement accounts, that's done with one form in particular, one piece of paperwork, the beneficiary form, right? We can't emphasize how important this form is, and yet time and time again, people fail to update these forms after major life events, such as births, deaths, marriages, divorces. Many times people think that because they've updated their will, everything is taken care of. That's not the case. Take an example. If you have your ex-wife or ex-husband named as your IRA beneficiary, but your will has been updated to say that all your assets go to your children, guess who's getting that IRA? Your ex. And we can't tell you how often this happens to people. That's why it's so important to keep updated copies of your beneficiary forms with all your other important estate planning documents. Now that we understand the importance of designating the accurate beneficiaries, let's talk a little bit more about IRA beneficiaries. Any person or entity can be an IRA beneficiary, but there are different post-death withdrawal rules depending on the type of beneficiary you select. Broadly speaking, there are three main types of beneficiaries after the recent SECURE Act that Congress passed a few years ago. There are non-designated beneficiaries, designated beneficiaries, and eligible designated beneficiaries. As you could probably guess by looking at this slide, non-designated beneficiaries generally have the worst tax treatment, and eligible designated beneficiaries generally have the most favorable tax treatment. You might be thinking to yourself, then, well, shouldn't I just make all of my beneficiaries eligible designated ones? Unfortunately, in many cases, that's just not possible, at least if you want to make sure that specific people in your life get your retirement savings. For instance, take a look at the different types of the eligible designated beneficiaries. So certainly no one is going to hope that their beneficiaries are disabled or chronically ill. And if you don't have minor children now, it's highly unlikely you're going to have one in the future. The trusts that you see there are generally only trusts where the only beneficiary of the trust is another type of eligible designated beneficiary, such as a disabled person. So that doesn't work either. So this leaves us with beneficiaries who are not more than 10 years younger than you are, which generally won't happen unless you're leaving your IRA to your siblings, friends, cousins, spouses. If you're married, chances are that your spouse is your beneficiary, but when that second death occurs, who will receive your collective retirement funds? In many cases, it's going to be your adult children who fall into that middle blue category. So we're going to take a closer look at the rules for post-death distributions for each of these categories, focusing on the ones that are most commonly applicable. Let's start with the group that has the most unfavorable treatment, non-designated. This group is comprised of beneficiaries who have no life expectancy. It includes your estate and charity. As you can see, the rules for how quickly the money must be distributed from an inherited account after death depend on how old the owner of the account was when they died. In many cases, that means such beneficiaries must distribute the entire inherited account within 5 years. This can lead to big lumps of income that get taxed at much higher rates than an owner might have paid during their lifetime. Next, we have designated beneficiaries. If you have children, grandchildren, nieces, nephews, or other similar close friends and family members who are not your spouse as your beneficiary, there's a good chance they're going to fall into this category. In the past, this group of beneficiaries was able to take advantage of something commonly known as the stretch IRA, which is where distributions from the inherited account could be spread out over the individual's life expectancy. This allowed the tax benefits of the retirement account to last for as long as possible and keep taxable income each year to a minimum for the person who inherited that account. It would keep going for as long as the account had money in it, right? Unfortunately, the Secure Act, the same law from 2019 that we've mentioned a few times, eliminated this tax benefit for regular designated beneficiaries. Instead, this group of beneficiaries now has to distribute the entire inherited IRA account by the end of the 10th year they inherited it. This new 10-year rule isn't as bad as the 5-year one that hits the entities, but it is a far cry from the decades that children and some grandchildren used to be able to spread out distributions before this law changed a few years ago. So for those of you who expect to pass on retirement accounts to heirs, should be particularly mindful of this change, right? As it might influence strategy decisions during your own lifetime, such as how much, if anything, to convert to Roth IRAs or other ways that you can have tax-free money passed to the next generation, okay? The new 10-year rule, effective for most IRA beneficiaries and plan beneficiaries, did begin in 2020, okay? Finally, we get to the brand new type of beneficiary created by the Secure Act, eligible designated beneficiaries. So this is the one we first mentioned, okay? These are the only group that are still allowed to stretch out IRA distributions using the old rules that used to be in place, okay? As we discussed, however, it's a pretty limited list of folks, and it doesn't help many of you who plan to eventually leave your retirement assets to your adult children or other persons who don't fall into one of the above categories on the screen. And this is what it means to stretch IRA distributions. Eligible designated beneficiaries, and only these types of beneficiaries, are able to take minimum distributions calculated over their IRS-provided life expectancy. So the same life expectancy factor concept that applies when you turn 72 or 73 in your own retirement, they're just different numbers, okay, for individuals that are this type of beneficiary starting at age 0, okay? And that will dictate how little they can take out from the IRA as an inherited status, okay? So the stretch IRA then is just the name that practitioners have given to the strategy of a beneficiary taking only the minimum amount of an inherited IRA each year that's required by law. Doing so helps an eligible designated beneficiary to minimize their income tax and maximize the deferral of those taxes of the inherited account. In contrast, all other beneficiaries typically have to withdraw all of the account and claim it as income a lot sooner, as we just discussed. Another question that a lot of baby boomers ask is whether or not they should leave their IRAs to a trust. Trusts are certainly good at providing post-death control, and if that's not a major concern to you, it's certainly something to consider. However, naming a trust as your beneficiary for your IRA adds considerable complexity to your estate plan. If it's drafted properly, a trust can be treated as a designated beneficiary and preserve the stretch IRA. All too often, however, they don't meet the specific requirements outlined by the IRS and end up having to follow the less favorable rules for non-designated beneficiaries. Even if they are drafted properly, trusts come with certain costs, such as the cost to prepare the trust itself, the cost for filing the annual trust income tax return, and accelerated taxation of any IRA withdrawals that are held inside the trust. Ultimately, naming a trust as your IRA beneficiary is a very complicated matter and is something that should be carefully considered and discussed with your full team of advisors, including your tax advisor, your financial advisor, but most importantly, your estate planning attorney. Many people name their spouse as the beneficiary of their IRA, so let's talk about that for a moment. If your spouse is your sole IRA beneficiary, then he or she will generally have several options after inheriting your IRA. They include choosing to remain a beneficiary of your account, as well as making it what is known as a spousal rollover. So we're going to talk about each of these in a little bit more detail before we wrap up. As we just mentioned, one option as a spousal beneficiary is completing a spousal rollover. In a spousal rollover, the surviving spouse takes the deceased spouse's IRA and moves it right into their own. A spousal IRA rollover is an undoable decision. Once it's completed, the funds are treated as though they were always in the surviving spouse's IRA. This is generally the best option for spouses who inherit at the age of 59 and a half or older, because if my spouse passes away and I claim the IRA as my own, if I'm over 59 and a half, I'm allowed to start claiming that money at my current age. If I'm younger though, it's something that I might want to watch out for, that I am not eligible to receive that yet, okay? Another option available to spouses is to remain as the beneficiary. This is generally the preferred option if I'm under 59 and a half, because it allows me to take tax penalty-free distributions from the inherited account regardless of their age, okay? In contrast, if they were to make a spousal rollover, the money would be treated as their own, and therefore any distributions made prior to the age 59 and a half would be assessed that 10% early distribution penalty. With that, we've come to our last IRA planning strategy. It's one that's easier said than done. For whatever reason, people seem to forget it. And that's to always do your homework before making any IRA decisions, okay? Especially when it comes to investments. IRAs are often the target of schemes, scams, because let's face it, there's a lot of people's savings here. There are a lot of dollars at play. I know it, you know it, but who else knows it? People who are nefarious in intention, scammers. In recent years, the SEC has issued alerts warning certain IRA owners that they may be the target of scams. And the IRS has even put out a publication with the title, "The IRS Does Not Approve IRA Investments," in response to many fraudulent promoters claiming that their IRA investments were somehow given the green light by the IRS. That's not a thing. At the end of the day, it comes down to the golden rule. If it sounds too good to be true, it probably is. Your IRA may represent a lifetime's worth of work and savings, so don't squander it by making a foolish decision without doing your homework. All right, we've certainly provided, covered a lot of ground today. You should have plenty of food for thought. Okay, hopefully we've answered some of your questions. A lot of times we find that you come away with more questions than you came in with. Okay, as you probably realized by this point, IRA planning is a lot more complicated than most people realize. Let's face it, deciding what strategies are best for your retirement dollars crosses into just about every other area of financial planning, from tax strategies to investment strategies to estate planning, right? Few retirees are aware of just how critical IRA planning is, and even fewer have taken the time to truly evaluate all the issues and develop a comprehensive solution. So hopefully we've helped answer some of your questions for you today, but chances are that you still have others, and that's okay. Okay, that's what people in Kofi, in Kofi and myself, are here for. We are here to help answer your important questions, evaluate your current financial picture, and develop an IRA planning strategy that's best for you and your family. Okay, so with that, I want to thank everyone for joining us. Best of luck for continued success. As a reminder, our team website with the link to schedule time to learn more or to speak with us, get a second opinion on what you have set up, ask any questions, request that we send you any information that we went through, reference guides, tax brackets, things like that. I just dropped that link in the chat again. Okay. And thank you guys again for taking the time. I hope to speak with you soon.
Thank you, Rory. Boy, that certainly was a lot of information.
Yes, it's a dense one.
Oh my goodness. I'm so glad I didn't have to write all that down. But thank you so much. And we look forward to our next session with you next month. We do have Financial Fridays every month with a different topic. And thank you for joining us today. Thanks again, Rory. Talk to you soon.
Thank you. Take care.